Welcome. In this explainer, we're going to break down the hidden connections in today's really volatile markets. We'll trace the whole chain reaction, starting from a single barrel of oil all the way to the price of every asset you're watching.
Exactly. So, where does this all begin? Let's dive right in. You can feel it, right? There's this real sense of uncertainty in the markets. But it isn't just random noise. There's actually a logical chain of events we can follow, a macro domino effect that explains a lot of what's going on.
And it all starts with the market's own measure of fear.
So this is the VIX. You probably know it as the market's fear gauge. And right now, we're seeing it at 29.
And the key thing to know here is that anything over 25 is a pretty big deal. It signals that market confidence is fragile. What it really means is that investors are out there actively buying protection, paying up to hedge against potential drops. That tells you one thing: they're nervous.
Okay, so to understand that nervousness, we have to start at the very beginning, the source of all this pressure. And that first link in the chain, that first domino, is the price of energy.
This is the key number right now. Brent Crude is trading at $103 a barrel. It's holding strong above that really important, psychologically huge $100 mark.
And this slide really gets to the heart of why that number is so central. Think of it as the anchor for all the volatility we're seeing. These high prices, which are being propped up by geopolitical risks, are exactly what's keeping everyone's inflation expectations so high.
And that is the crucial point. An energy shock like this is ground zero. It's the very first link in the whole macro chain, and it kicks everything else off, starting with inflation.
So, let's follow the trail. How does that pressure from a barrel of oil actually snake its way through the entire financial system? It's not magic. It's a surprisingly predictable sequence.
The market still follows this classic macro playbook. First, high oil prices push up what people think inflation is going to be.
Right, and that in turn forces bond yields higher to compensate. Higher yields then strengthen the US dollar. A stronger dollar tightens the financial screws on the whole world, which ultimately puts pressure on risk assets like stocks and crypto. If you get this chain, you pretty much get what's moving markets right now.
Okay, so following that sequence, the next domino to fall is bond yields. The 10-year U.S. Treasury is now sitting at 4.44%. And that number is a big deal because yields are now getting very close to what we call the equity pressure zone. That 4.4 to 4.5% range is historically where rising rates start to feel really heavy for the stock market.
That's exactly right. Look, when yields go up, borrowing just becomes more expensive for everyone. But for stocks, there's another layer. It literally changes the math that analysts use to figure out what a company is worth. Yeah, to put it simply, all the earnings a company is expected to make in the future, they're suddenly worth less today. And that, just by simple math, pushes stock prices down. It's a very direct relationship.
The next link in that chain is the U.S. dollar. The dollar index, or the DXY, is sitting right at 99.9, and it's basically knocking on the door of a critical level. Once that DXY moves above 100, it's historically been a big flashing sign that financial conditions around the globe are getting tighter.
So why does that matter? Well, think of a strong dollar like a giant vacuum cleaner, just sucking liquidity or money out of the global system.
And that puts a huge squeeze on pretty much everything, from emerging markets that often have to borrow in dollars to commodities and other assets that are priced in dollars.
So, we've seen the pressure build up from oil to yields and then to the dollar. Now let's look at the consequences. What does this mean for the assets that investors are watching so closely?
We'll start with Bitcoin, currently at $65,000, but we're not just looking at it as a crypto asset here. Right now, think of it more as a real-time signal for the market's overall appetite for risk. Yeah, crypto markets often act like the canary in the coal mine. They react to tighter money conditions much faster than traditional markets. So the fact that Bitcoin recently broke below a key neutral zone, that suggests there's a growing sense of caution across the board. Exactly. Its weakness is often an early warning signal. It can lead these shifts in sentiment well before the stock market fully catches up. All right, now for a more complex case, gold. It's at $4,460, and this asset is caught in a really fascinating tug-of-war between two totally opposite forces. On one hand, you have the fear of inflation. That's a pro-gold force, right? It drives people to buy it as a classic safe haven. But on the other hand, you have that rate pressure we talked about. Higher bond yields make holding gold, which pays you nothing, a lot less attractive.
So the fact that gold has stayed so strong despite those higher rates, that's a really powerful signal. It tells us there's some deep underlying macro and geopolitical worry out there that is still leading investors to seek that protection.
Okay, so to make all of this practical,
Here are the specific numbers you need to watch, the thresholds that could signal when these pressures might really ramp up. Think of it as a trader's dashboard for what's happening right now.
For Brent crude, a move above 110 would signal a serious inflation shock risk. For the 10-year Treasury, if it gets above 4.5%, you're in that equity pressure zone we mentioned.
For the DXY, a sustained move over 100 signals that money is definitely tightening.
For Bitcoin, a drop below $65,000 could warn of a broader risk-off acceleration.
And finally, the VIX, a move above 30 indicates a real spike in volatility and a whole lot more fear.
All right, let's boil this all down. What does this all mean for you and the markets right now? It really comes down to a few key ideas. First, volatility is clearly rising, and it's happening across pretty much all assets. Second, the dominant drivers of everything right now are higher oil prices and higher bond yields, period. Third, Bitcoin's recent weakness is a really important hint that liquidity conditions are getting tighter for everybody. And finally, the ultimate takeaway is that this big picture chain reaction, the macro story, is still leading the market. You have to watch yields, oil, and volatility.
Which leaves us with a final question to think about. As the world gets more and more complex and headlines are flying faster than ever, in a world this volatile, is this classic domino effect the one signal that still truly matters?